investing is gambling. It is literally a casino.
I was at a family party the other day, and my auntie Mandy said something to me. She said, basically, I don't invest, Damien, because it's just gambling. Have I just made that story up for the purpose of setting up this video? I mean, place your bets now. But this comment is very much real, and so is this one. And if I said to you that I was about to risk some money in the hope of getting more money, but there's a chance that I would lose some of that money, would I be describing investing to you or gambling? Does my potentially fictitious auntie have a point? So I'm going to draw a line, and at this end we have investing, whatever that means. And at this end I want you to give me your best example of outright gambling. Russian roulette, rolling the dice, just woke up in Vegas, there's a tiger in the bathroom and I married a stripper, that kind of activity. So what separates these two, and how do we place potential financial products along this line? That was the exact question posed by this paper, titled The Conceptual and Empirical Relationship Between Gambling, Investing and Speculation. Amazing paper, terrible title. I'd have called it something like The Differences Between Dice, Deals and Dividends. Anyway, they produced this table, which looks at the differences between gambling, investing, and then that bit in the middle that they call speculation. We're going to start today by looking at the stake.
That's a high-stakes game.
Wanna bet?
Very conveniently for today's video, there's currently a legal battle raging in Australia between two different companies with the same name, arguing over who should use it. Both are called Stake. One is an investing platform founded in Melbourne, the other is a prominent gambling site from Sydney, the one that Drake is always promoting on live streams to his young and impressionable audience.
Give us another one.
But that's a minor segue. I'm not here to talk about Drizzy, or the legal battle even. If I was, I would say that the gambling site should win, simply because of the word itself. A sum of money or something else of value gambled on the outcome of a risky game or venture. All forms of gambling involve the staking or proffering money or material goods. In contrast, the asset is never explicitly staked in an investment. So along our line, anything that involves you placing money down that if you lose, you don't get it back is gambling. Anything that results in owning something could be called an investment. So what then falls in the middle? In the 2 years between 1927 and 1929, 20 million Americans purchased shares in the US. This was a time of economic optimism due to widespread adoption of new technologies like electricity. The Americans were so optimistic about the future of the American market, many of those 20 million people actually borrowed money to buy shares. Lenders let people borrow up to 90% of the stock's value, which meant that people bought 10 times more shares than they could really afford. When the crash came, lenders asked for more money to cover losses or forced people to sell. This triggered a rapid market collapse. This introduction of leverage or debt turned investing into speculation and then moved that activity up the line. Because think about it, they no longer owned the thing they were buying as they borrowed 90% of the money to buy it. I think property investors can often forget this point, that the risks around leverage, which amplifies returns, yes, but it also creates a downside risk. Because if you've borrowed 75% of the value of something, who really owns it? Lack of ownership increases overall risk. Because the risk presented of losing everything on a single outcome is, of course, way higher than the potential of you owning something and then it dropping in value a bit. This is why the success of gamblers is always dominated by moments. You know, the next spin, the next goal, the next roll of the dice. The presence of a stake and the lack of ownership that that stake then represents constantly resets the game. It wipes the slate clean, it restarts the clock.
The longer they play, the more they lose.
In the short term, investing and gambling can look and feel very similar. So a coin toss is roughly a 50-50 bet. And if you invested in the global stock market for just one day over the last 50 years, the odds of you making money were around 52%, pretty much a coin toss. I think it's that reality that led to my auntie, that may or may not exist, thinking gambling and investing are similar things. If we made a chart where we had returns on one side here, anything above this is a win and anything below this is a loss. If you plotted the range of outcomes from both investing and gambling over a short period of time, they look very similar. Where this gets interesting is if we stretch out a new line that represents time. And what we're saying now is what happens if you play the game for longer, if you invest for longer. August 18th, 1913 in the Monte Carlo Casino, an infamous night in gambling history, and the perfect example of the gambler's fallacy, sometimes called the Monte Carlo fallacy because of this night. So punters on this night lost millions betting on red on a particular roulette table that produced 26 black numbers in a row. The odds of 26 blacks in a row are about 1 in 66 million. So gamblers thought, well, a red has got to be due. But probability doesn't work that way. Even after 10,000 blacks in a row, the next spin is still roughly a 50-50 chance. The previous results do not influence the next outcome of the game. I say roughly 50-50 because with roulette specifically, the presence of a 0 on the board gives the house an edge. What I mean by that is the game is rigged in the casino's favour. So this can be expressed as a percentage and can also be described as expected value. And another way of thinking about this is, for every £100 that you gamble on the roulette table, how much should the casino take off you? And this can range from nearly £2 in every 100 all the way up to £8. Some roulette tables can have 3 zeros on them, and that shifts the odds in their favour. So for every £100 you play, that's how much money you can expect to lose long term. Of course, luck is a huge factor in this, but the longer you sit there, the more you're expected to lose over time. People will claim that they can beat the house. One common approach with roulette is the martingale strategy. So this is where you continually double your bet every single time you lose, betting on red or black in the hope that at some point your colour will come up. The issue with this is you need infinitely deep pockets. If you continue to double your bet every single time, go do the maths, the numbers get pretty scary pretty quick, and this is what wiped out those people in Monte Carlo. Also, casinos are wise to this. They put max bets or limits on tables so you hit a ceiling and you can't go past it. The house always wins. The casinos in Vegas don't survive on thin air. Denise Coates is not the highest paid director in the UK with the most expensive house in the UK because she's a diligent saver. But I am diligent with my finances, and the main tool I use to keep on top of my business finances is Xero, who are today's video sponsor. I have a few different companies and we run all of the finances through Xero. I say we because basically my mum does it all. She implemented Xero when she started working for me. She used to work at a really big company, used Xero there when she did the bookkeeping. And one of the terms of her coming and working for me was, I want Xero. She implemented it, it was seamless. They have automatic invoices and customizable reporting. But I think most importantly, they link directly to HMRC, which is about to become really important due to the incoming making tax digital requirements. And not just for limited company owners, if you're a sole trader or a landlord earning over £50,000 a year, you'll need to submit your tax returns through approved software like Xero. They can help with that. I love it, so does my mom. She's 100% real, I'll prove it actually. Here we go. This is mother here, lovely hair. She's gonna hate me sharing that picture, but anyway, there we go. If you wanna check out Xero, I've got a special offer for you, and I'll leave all the details of that in a link in the description or the pinned comment below. But let's get back to the video. So, the longer you gamble, the more your expected return goes from this to this. Investing, on the other hand, when done properly, you're buying productive assets with real-world value that generate cash flows, dividends, growth. This means the expected value of a well-diversified investment portfolio goes like this over time. Buying the global stock market means that I'm backing the world's best minds as they build and sell for profit, and I own a slice of that. Gambling is the exact opposite. I'm trying to beat those same minds at a game that they've designed to be rigged for their benefit. Gambling has a negative expected value. The longer you play, the more you're expected to lose. Investing is the complete opposite. Speculation, I think, is anything in the middle then. Any investing activity that relies on short-term outcomes and doesn't benefit from this time factor. So anything that removes the benefit of riding that long-term trending upwards of the stock market over time. So things like day trading that expose you to the day-to-day noise of the market, move you away from investing and closer to speculation. Successful day traders will debate that point, but the fact that 90% of day traders lose money shows that this activity is speculative. So the next thing I want to look at is economic utility. Bet365 is one of the largest gambling companies in the UK. It's a huge employer in Stoke-on-Trent, has done wonders for the local economy, and its founder, Denise Coates, has received the CBE for services to the community and business. Just 1 mile north of Bet365's impressive headquarters, just down the A53, is a much less impressive building, the West Midlands Gambling Harms Clinic. It's not because of the location of Bet365 that this clinic is here. The most socially economic and deprived disadvantaged groups have the highest levels of harmful gambling. Stoke, a collection of 6 different towns, ranks 12th in terms of deprived neighbourhoods nationally. There are said to be about 1 million people with a gambling problem in the UK. 18% of all online gamblers have debt, about £10,000 on average, and there are 55,000 children between the ages of 11 and 16 described as having a gambling problem in the United Kingdom. 60% of all profits generated from gambling companies come from just 5% of its customers. I know that many people just enjoy gambling responsibly, like many people enjoy a drink or other more illicit activities that cause harm to a few. And I'm not sat here comparing gambling companies to dealers of Charlie or Mandy, but gambling is addictive and it's a zero-sum game. The majority of gamblers, the vast majority, are left with nothing to show for it. Money flows from the many into the hands of the few through gambling, around 16 billion a year. And that money is money that could have been deployed elsewhere in the economy. The broader stock market is the opposite. It's generally a positive-sum game over the long term. Because capital supports economic growth, creates jobs and generates wealth that benefits investors overall. So I invest in the global stock market through my index funds. And what that means is I receive income and returns from investing in those global businesses. This is then money that I can spend in the UK economy. Without the ability to invest, I would have used the services and products of these companies like Google and Facebook and things like this, but I wouldn't have benefited from them financially. The ability to own the growth of other countries, bring that back to the UK and then spend it is sort of amazing when you think about it. When you gamble, for the company to win, you have to lose. When you invest, if the company wins, you win. Speculation then would be any investment where the broker benefits if you lose or trade excessively, I would say. Examples off the top of my head would include CFDs or copy trading platforms that push frequent trades to generate fees, such as eToro's copy trader thing. They basically want you to copy people that trade loads because then they generate lots of fees. Ask yourself whenever you buy into a financial product, what are the incentives of the person selling this to me? For example, as a Vanguard customer, Vanguard charges a percentage fee based on how much money I hold in their funds. So they're directly incentivized for me to have more money because then they get a bigger slice from those percentage fees. There's one final thing missing from this list that I want to add as well.
New season, new players.
In 2019, the gambling industry introduced a self-imposed ban on adverts for gambling during football games. They call this the whistle-to-whistle ban, and they've hailed it as a great success, supposedly reducing the exposure of ads to people, especially kids. But I found some analysis from 2024 that looked at the number of betting adverts people were exposed to simply on the opening weekend of the Premier League season. They found that it had trebled in a single year. In the West Ham match against Aston Villa, they counted close to 6,500 gambling adverts across radio, shirt sponsors, and hoardings. They said that this averaged 30 every minute or 1 every 2 seconds. In 2005, we had the introduction of what was known as the Gambling Act, and since then, gambling advertising has increased substantially. That's the word of the government, not me. It's interesting that Denise Coates' family donated to the Labour Party for the first time just before that Gambling Act came into force in 2004. But anyway, many of these adverts give people the impression that, first of all, they have control.
With cash out, you're in control.
And that the chances of winning are high or normal.
See? Special. Not really, mate. Someone wins that jackpot every single day.
But the truth is, and I think this would probably surprise people, those who actually know how to win are labelled as problem clients by the industry and they're restricted or banned from betting at all.
But if you were a problem customer, that meant that you were winning money. So you'd be labelled with a big badge that said that you're a problem and that needs to be dealt with.
This is a rigged game, even the sports betting. Just do me a favour, right? Next time you're out and about, count how many times you see a gambling advert versus how many times you see an investing one. If you want to talk about the benefits of investing, if I want to sit here and say to you that you should invest, I need all sorts of disclaimers and risk warnings, whereas the gambling industry can get away with things like this in the corner of the screen. I think there's a direct correlation between the more aggressively you see a financial instrument being promoted and the more likely it is to be risky or gambling. Just ask Greg Secker. And I just think this deluge, this constant barrage of advertising around gambling has warped the public's perception of this industry and of how risky it is. Do you think the average person in the street would say that it's easier to make money from sports betting than it is from investing? I think so, and I think the numbers suggest that. Nearly 2/3 of people in the UK gamble at least once a month, yet only 1/4 of adults have purchased shares in 2025. Gambling extracts value, while investing builds it. I would go as far to say that if you don't invest, you're taking a huge gamble with your future. So just consider that the next time you're tempted to place a bet. I mean, did you take that bet on my auntie being real or not?
Because if you did, you probably just lost.
The house always wins.
Beautifully acted, Number.